Nothing disrupts business operations quite like a tax investigation. It can be stressful, time-consuming, and costly. Avoiding the common triggers of these investigations can save you a world of hassle. Let's dive into the practices that could draw unwanted attention from the tax authorities and how you can steer clear of them. Tax investigations don't come out of nowhere. They are often triggered by discrepancies or anomalies that can catch the eye of the Federal Inland Revenue Service or State Internal Revenue Services. Recognizing what these triggers are can help you maintain a clean and compliant financial profile. Inconsistent information. Submitting inconsistent information across your tax returns or between your returns and financial statements can raise red flags. For instance, if your reported expenses suddenly spike without a corresponding increase in revenue, it may prompt an inquiry. Excessive deductions. While deductions are a legitimate way to reduce tax liabilities, claiming excessive or unusual deductions compared to others in your industry can make you stand out. Be realistic and only claim deductions for which you have clear, verifiable documentation.
The issue of deductions is because that deduction, we need to clarify it. If it's withholding tax we are talking about, the withholding tax in advance is advance payment of tax on the activities of the service provider. So the best thing is that taxpayers must ensure that all the expenses incurred and there is agreement to it, then such an expenses is liable to deduction of withholding tax. The issue of withholding tax is just to help the two parties. One, the government doesn't want to wait till the end of the year before they collect tax from taxpayers, because if they should wait, it will affect their budget. That's why I say, look, every month make deduction to ease our cash flow. Whereas the taxpayer too, when you are now getting your income, it will not be too much for you to pay in one lump sum. So what we can advise that first of all, the taxpayer must know the rate of withholding taxes due and the transaction that is liable to withholding tax. But any cash transaction or across the counter transaction is not liable to withholding tax. What I mean by that if I go to just right now to go and buy something, there's no way I can do withholding tax, because as I assemble all what I want to buy, take to the counter, they will just give me what is my money and I will pay. That's when it's across the counter transaction. You can't deduct withholding tax. But if you supply based on contract, they give fashion Lasisi Enterprises to supply tire to Guinness. I'm a contractor to Guinness. So when they are paying me, they should pay withholding tax on my income. If I specify it to okay, this is the cost of this tire to me. This is my own service charge for rendering that service, but going to factory or to import it for them. But what I'm taking on that amount, they deduct withholding tax. So what I can advise taxpayer in this respect is to ensure that they split their cost into two. Because if they go to the market to go and buy something and they are supplying it, it is only the service portion that is liable to tax, because what government is saying that on your income they want to deduct they want to take tax in advance on it, and both the cost and your service is not your income. It's only the portion that you are putting by way of doing that one on behalf of that company that is your income. That's what's supposed to be. That's where the money have problem, because in most companies they will deduct withholding tax on the total cost, whereas its margin may be just 10% of the amount. So if you now deduct more than that one, then that means that its profit has been eroded. So what we can just tell taxpayer is to identify the income that is meant for you on that transaction. But in most cases, because we are not truthful and we are not honest, we don't state the correct margin. That is why the revenue will now decide, look, we want to apportion withholding tax on everything. So what we are saying to the taxpayer or the taxpayer, either in or out, is that to identify their income very well, so that they won't have excess withholding tax to be claimed from the government. Because even the claim credit refund from the government, they say you want to do your audit. Without audit, you can't get a refund, and that refund again, you can't get it in cash. In most cases, they will tell you that you have to use to offset your future tax liability.
Large sum transactions, deposits or withdrawals that are unusually large for the scale of your operations can also trigger an investigation. If these transactions are legitimate, make sure you document their source and purpose clearly. Frequent late filings or payments. Consistently missing deadlines for tax filings or payments suggests poor financial management and can lead to scrutiny. Use reminders and even tax software to keep track of deadlines. High volume of cash transactions. In today's digital age, a business that predominantly deals in cash can be seen as trying to evade taxes. Where possible, encourage electronic payments which are easier to track and substantiate. Rounded figures on tax returns. Frequently rounding up numbers on your tax returns can seem like you're estimating rather than reporting exact figures. Always strive for accuracy in your financial reporting. Remember, the key to avoiding tax investigations is transparency, consistency, and diligence in your financial management. Regular reviews with a financial advisor or a tax consultant can help ensure that you remain compliant and up the radar for investigations. Keeping your business finances clean and transparent isn't just about avoiding investigations. It's about building a robust foundation for your business growth. For more insights into managing your business finances effectively, subscribe to our channel. If you have questions or need guidance, drop a comment below or consult a tax professional. Let's keep thriving in our business endeavors with integrity.